If you are collecting Social Security right now, there is something happening in 2026 that nobody is explaining clearly. The Social Security Administration has quietly rolled out a set of changes that will directly affect your monthly check. Most seniors will not hear about these adjustments until the money has already shifted. I spent 30 years helping people just like you protect every dollar they earned, and today I am going to walk you through all of it. Here is what frustrates me the most about the way Washington handles your benefits. They announce changes buried inside 100-page documents that no normal person has time to read. Then they act surprised when millions of seniors miss critical deadlines or leave money on the table. You deserve someone who will sit down and explain this to you in plain English, and that is exactly what I am doing right now. By the end of this video, you will know 3 specific changes coming to your Social Security benefits in 2026. You will understand how each one could add or subtract real dollars from your monthly deposit. I will also reveal a little-known rule that most seniors never claim, even though they qualify. So grab your coffee, settle in, and let us make sure you are not leaving a single penny behind. Let me start with the big picture so everything else makes sense. The Social Security Administration serves over 67 million Americans every single month. According to SSA.gov, the average retired worker benefit in early 2025 was roughly $1,976 per month. Even a small percentage change to that number can mean hundreds of dollars over the course of a year. Now, every year the SSA adjusts benefits based on something called the Cost of Living Adjustment, or COLA. For 2026, the trustees project a COLA somewhere between 2.2 and 2.8%. That might sound small, but on a $2,000 monthly benefit, even 2.5% adds about $50 a month. The problem is that other costs rising at the same time can eat that increase before you ever feel it. Think of it like this. Imagine you get a $50 raise at work, but your rent goes up $40. You technically earned more, but your life did not actually get any easier. That is exactly what happens to millions of seniors every single year with Social Security. Your COLA goes up, but Medicare premiums, prescription costs, and inflation quietly swallow the difference. Understanding the mechanics behind this is the first step to protecting yourself. The Social Security Trust Fund is also part of this conversation, whether we like it or not. The 2024 Trustees Report projected the combined trust fund reserves could be depleted by 2035. That does not mean benefits disappear entirely, but it could mean a reduction to about 83 cents on the dollar. Knowing this timeline helps you plan smarter today rather than panicking tomorrow. One more piece of context before we dive into the specifics that matter most to your wallet. The SSA has also been updating its earnings test thresholds, full retirement age calculations, and spousal benefit formulas. These are not headline-grabbing changes, but they directly impact how much money hits your bank account. I am going to break each of these down so you know exactly where you stand heading into 2026. Let us start with the first major change, the 2026 COLA, and how it actually flows into your check. According to SSA.gov projections and Congressional Budget Office estimates, the 2026 COLA is expected to land near 2.5%. On the current average benefit of $1,976, that translates to roughly $49 more per month. Over a full year, that is an additional $588 in your pocket, assuming nothing else changes. But here is the catch that trips up almost everyone. Your Medicare Part B premium is deducted directly from your Social Security check before you ever see it. If Part B premiums rise by even $10 a month, your net COLA increase drops from $49 to $39. That is a 20% reduction in your raise before you have bought a single grocery. For 2026, CMS.gov has indicated that Part B premiums could increase to approximately $190 per month or higher. In 2025, the standard Part B premium was $185 per month. That $5 difference alone costs you $60 over the year. When you subtract that from your $588 annual COLA gain, you are really only netting about $528. Now let us talk about the hold harmless provision, because this protects some of you but not all. This rule says your Social Security check cannot decrease because of a Medicare premium increase. However, it only applies if your Part B premium is deducted from your Social Security check. If you pay Part B separately, or if you are a higher income beneficiary subject to IRMAA surcharges, you do not get this protection. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is a surcharge on higher earners. If your modified adjusted gross income exceeded $103,000 as an individual in 2023, you are already paying more. For 2026, those income brackets may shift slightly, but the surcharges can add $70 to over $400 per month. I have seen retirees shocked when a one-time IRA withdrawal pushes them into a higher IRMAA bracket. Here is a real-world example so you can see how this plays out. Say you are 68 years old and receiving $2,200 per month in Social Security. A 2.5% COLA gives you an extra $55 per month starting January 2026. But if your Part B premium rises $5 and you are in the first IRMAA tier adding $74, your net gain could actually become a net loss. That scenario is not rare. It happens to hundreds of thousands of seniors every single year. The SSA does not send you a warning letter saying your COLA will be absorbed. You simply notice in January that your deposit is smaller than you expected. This is why understanding the interaction between COLA, Part B, and IRMAA is absolutely essential. Let me also address the earnings test, because this catches a lot of early retirees off guard. If you are under your full retirement age and still working, the SSA withholds $1 for every $2 you earn above a certain threshold. For 2025, that threshold was $22,320, and for 2026, it is expected to rise modestly to around $23,000. Earning even a few $1,000s over that limit can reduce your Social Security check significantly. Here is the good news that most people do not realize about the earnings test. The money withheld is not gone forever. The SSA recalculates your benefit at full retirement age. Your monthly payment actually goes up to account for the month's benefits were withheld. But between now and then, the reduced checks can create real cash flow problems if you are not planning ahead. I also want to touch on the special rule for the first year of retirement. In the year you retire, the SSA uses a monthly earnings test instead of an annual one. That means you can earn any amount in the months before you retire, and it will not count against you. This is a planning opportunity that most financial advisors do not even mention to their clients. Stay with me, because what I am about to show you will surprise even the most prepared retirees. The next section covers a mistake I have seen cost people thousands of dollars. It involves your full retirement age and the decision of when to start collecting. Getting this wrong by even 1 month can permanently reduce your benefit for life. Let us talk about full retirement age, because the rules are shifting and many seniors are confused. If you were born in 1960 or later, your full retirement age is 67, not 65 or 66. Claiming at 62 permanently reduces your benefit by up to 30%. That reduction is not temporary. It follows you for the rest of your life. Here is what that looks like in real dollars, because the math is eye-opening. Suppose your full retirement age benefit would be $2,400 per month at age 67. If you claim at 62, that drops to approximately $1,680 per month. Over 20 years of retirement, That early filing decision costs you roughly $172,800 in total benefits. Now consider the other side. Delayed retirement credits. For every year you delay past your full retirement age up to age 70, your benefit grows by 8%. Waiting from 67 to 70 would increase that $2,400 benefit to approximately $2,976 per month. That is an extra $576 every single month for the rest of your life. I know what you are thinking. What if I do not live long enough to make up the difference? That is a fair question. And the break-even age is typically around 80 to 82 years old. If you are in good health and have family history of longevity, delaying often pays off handsomely. But if you have serious health concerns, claiming earlier can make more sense for your situation. Let me give you a couple specific examples that shows how strategy matters. John and Mary are both 66, and John's full retirement age benefit is $2,600. Mary's own benefit is $1,100. But she is also eligible for a spousal benefit. If John delays to 70, his benefit grows to $3,224, and Mary's spousal benefit also increases because it is based on John's record. In this scenario, John waiting until 70 could mean an extra $624 per month for himself. Mary's spousal benefit could increase from roughly $1,100 to nearly $1,300 depending on calculations. Combined, this couple gains over $900 per month by making one strategic decision. Over 15 years, that adds up to more than $162,000 in additional household income. Now here is a 2026 specific wrinkle that not many people are discussing. The SSA is updating its actuarial tables and processing systems, which could affect benefit calculations for new filers. If you are planning to file for Social Security in 2026, make sure your earnings record is completely accurate. Even a single missing year of earnings can reduce your benefit by $20 to $50 per month permanently. You can check your earnings record right now for free at ssa.gov by creating a My Social Security account. Log in, review every year of earnings listed, and compare it against your own tax records or W-2s. If you find an error, you can correct it by contacting the SSA with supporting documentation. I recommend doing this at least 6 months before you plan to file, so any corrections are processed in time. Another common mistake I see involves divorced spouses who do not realize they qualify for benefits. If your marriage lasted at least 10 years and you are currently unmarried, you may be eligible for benefits on your ex-spouse's record. This benefit can be up to 50% of your ex-spouse's full retirement age amount. Your ex-spouse does not even need to know you are claiming, and it does not reduce their benefit at all. For 2026, this could mean a divorced spouse receiving up to $1,200 per month or more on an ex-spouse's record. I have personally helped dozens of people discover they were eligible for this benefit after years of not knowing. The key requirement is that you must be at least 62 years old, and your divorce must have been final for at least 2 years. If you remarried, you generally lose eligibility unless that subsequent marriage also ended. Now here is the part most seniors never hear about, and it could put real money back in your pocket. This section covers survivor benefits, tax strategies, and a provision that could save you over $1,000 a year. If you have lost a spouse, or if you are planning ahead for your surviving partner, this information is critical. Let me walk you through it step by step. Survivor benefits are one of the most valuable and most misunderstood parts of Social Security. If your spouse passes away, you may be eligible to receive up to 100% of their benefit amount. This is not the same as a spousal benefit, which maxes out at 50% while your spouse is alive. The survivor benefit can be significantly higher, especially if your spouse had delayed claiming past full retirement age. Here is an example that shows the real impact of this. If your late spouse was receiving $2,800 per month, you could step into that full $2,800 as a survivor benefit. If you were receiving $1,500 on your own record, switching to the survivor benefit gives you $1,300 more per month. That is $15,600 per year in additional income that many surviving spouses never claim because nobody told them. There is also a strategy where you can claim a reduced survivor benefit as early as age 60. You then switch to your own retirement benefit at 70 when it has grown with delayed credits. This is perfectly legal and can maximize your total lifetime benefits substantially. However, you must coordinate the timing carefully, and I strongly recommend talking to the SSA directly about your specific situation. For 2026, there are also potential changes to how the SSA handles overpayment clawbacks for survivors. In recent years, the SSA has been aggressively pursuing overpayments, sometimes years after they occurred. New proposed rules may give beneficiaries more time and flexibility to repay or dispute these overpayments. If you have received an overpayment notice, do not ignore it. You have the right to appeal or request a waiver. Now let us talk about taxes on your Social Security benefits, because this surprises almost everyone. Up to 85% of your Social Security income can be subject to federal income tax. The thresholds for this have not been adjusted for inflation since 1993, which means more seniors fall into this category every year. For a single filer, if your combined income exceeds $34,000, up to 85% of benefits are taxable. Combined income is your adjusted gross income, plus non-taxable interest, plus half of your Social Security benefits. For a married couple filing jointly, the 85% threshold is $44,000 in combined income. These thresholds have remained frozen for over 30 years while benefits and other income sources have grown. The result is that millions more seniors pay taxes on Social Security today than when the law was originally written. Here is a concrete tax-saving strategy for 2026 that many retirees overlook entirely. If you have a traditional IRA, consider doing Roth conversions in lower income years before you reach age 73. Converting a portion each year spreads out the tax hit and can reduce your future required minimum distributions. Lower RMDs mean lower combined income, which means less of your Social Security is taxed. For example, converting $15,000 from a traditional IRA to a Roth IRA might cost you $2,250 in taxes today at the 15% bracket, but it removes that $15,000 from future RMDs, potentially saving you taxes for decades. It also keeps your combined income lower, which could keep more of your Social Security tax-free. Over 10 years of strategic conversions, you could save $10,000 or more in total taxes. Let me also mention the Medicare premium connection to your tax planning. Remember, IRMA surcharges are based on your income from 2 years prior. A large IRA withdrawal in 2024 could trigger higher Medicare premiums in 2026. Planning your withdrawals and conversions with this 2-year look-back in mind is one of the smartest moves you can make. There is also a provision for reporting a life-changing event that many seniors do not know about. If you experienced a marriage, divorce, death of a spouse, work stoppage, or work reduction, you can request an IRMA reconsideration. You would file SSA Form SSA-44 to report the life-changing event. This can immediately reduce your Medicare premium surcharge to the standard amount, saving you hundreds per month. I have seen this single form save retirees between $840 and $4,800 per year depending on their situation. Yet most people who qualify never file it because they simply do not know it exists. If any of those qualifying life events happened to you recently, this should be your top priority. You can download the form directly from ssa.gov or request it by calling 1-800-772-1213. Now let me share the hidden gem that I promised you at the beginning of this video. There is a Social Security provision called the Windfall Elimination Provision, or WEP, and it has been penalizing certain retirees for decades. But legislation has been moving through Congress to reform or eliminate WEP entirely. If this passes in 2025 or 2026, affected retirees could see benefit increases of $100 to $500 per month. WEP affects people who worked in jobs not covered by Social Security, like certain government or teaching positions. If you also paid into Social Security through other employment, WEP reduces your Social Security benefit using a modified formula. According to the Congressional Research Service, approximately 2 million retirees are currently affected by WEP. If you are one of them, you need to be watching this legislation closely. The Social Security Fairness Act, which has gained bipartisan support, would repeal both WEP and the related government pension offset. If signed into law, your Social Security benefit could be recalculated without the WEP reduction. For some retirees, this means getting back $200 to $500 per month that they have been missing. Retroactive payments could also be on the table, depending on how the final legislation is written. Even if you are not affected by WEP, you should know about the lump sum retroactive benefit option. If you are past your full retirement age and have not yet filed, you can request up to 6 months of retroactive benefits. This means the SSA will pay you a lump sum for the months you could have collected but did not. For someone with a $2,400 monthly benefit, that is a one-time payment of up to $14,400. The catch is that your ongoing monthly benefit will be calculated as if you had filed 6 months earlier. That means slightly lower monthly checks going forward, because you lose 6 months of delayed credits. Whether this trade-off makes sense depends on your health, financial needs, and life expectancy. Run the numbers carefully or ask the SSA to show you both scenarios before you decide. Here are your action steps, and I want you to treat these like a to-do list starting today. First, log into your My Social Security account at ssa.gov and verify every year of your earnings record. Second, check your latest Social Security statement to see your projected benefit at ages 62, 67, and 70. If anything looks wrong, call the SSA at 1-800-772-1213 and ask for a correction. Third, if you are subject to IRMA surcharges and have experienced a qualifying life event, download Form SSA-44 from SSA.gov immediately. Fourth, review your combined income to determine whether up to 85% of your Social Security is being taxed. Fifth, if you are affected by WEP, contact your congressional representative and ask about the status of the Social Security Fairness Act. Every one of these steps is free and could save you hundreds or even thousands of dollars in 2026. If you are married or divorced, take time this week to understand your spousal and survivor benefit options. Visit ssa.gov and use the benefit calculators to compare different filing ages and strategies. Write down your numbers and bring them to any meeting with a financial advisor or the SSA. Knowledge is your best defense against leaving money on the table, and you have earned every dollar of these benefits. Let me bring it all together, so you walk away from this video knowing exactly what matters most. The 2026 COLA will give you a modest raise, but Medicare premium increases, IRMA surcharges, and taxes can quietly erode those gains. Understanding the interaction between these moving parts is the single most important thing you can do to protect your retirement income. Small decisions about when to claim, how to manage your income, and which forms to file can be worth tens of thousands of dollars over your lifetime. If this video helped you see your benefits more clearly, please hit that subscribe button so you do not miss what is coming next. I am working on a video about the 5 biggest Social Security mistakes retirees make in their first year of collecting. It is going to cover traps that cost people real money, and I want to make sure you avoid every one of them. This channel is for educational purposes only, and does not constitute financial or legal advice. Always verify directly with SSA.gov or Medicare.gov.